But they didn't call that recession officially until December of '08. And what they did is they went back and revised an entire year's worth of economic data. And they said, all the data that we gave you about how great the economy was for the past year, it turns out that none of it was accurate. In fact, we've been in a recession for the entire year. Nobody knew. The economy is a lot weaker than people expect, and inflation is a lot stronger. Instead of this Goldilocks scenario that people envision, it's the worst case scenario because you've got weak growth and inflation at the same time. And there are people that think that, well, those two situations are mutually exclusive, and they're not. I mean, that's what they thought in the 60s, and then came the 1970s. That's when they started using the word stagflation, because in the 60s, they thought the 70s was impossible. But then
in this video, Peter Schiff delves into the often overlooked reality of the current economic situation, contrasting the optimistic mainstream narrative with his more cautionary outlook. He begins by addressing the potential flaws in government economic data and the historical tendency for significant revisions. Schiff emphasizes the possibility that much of the positive data might be revised to reveal a weaker economy than initially reported. Schiff explains how inflation and sluggish growth can coexist, referencing the 1970s stagflation as a historical example. He highlights the risks of a mixed economic environment with slow growth and high inflation, contradicting the notion that these conditions are mutually exclusive. Moving into more recent developments, Schiff contrasts the mainstream view of a resilient U.S. economy with his concerns over record low savings rates, historically high household debt, and an over-reliance on part-time jobs. He suggests these factors indicate an economy in distress rather than one in robust health. Schiff also critiques the Federal Reserve's response to economic challenges, particularly its reliance on quantitative easing. He argues that this approach, essentially creating inflation by expanding the money supply, cannot solve a crisis caused by inflation. Schiff predicts that continued inflationary policies will further weaken the economy and reduce the purchasing power of ordinary Americans. Let's get back to the video.
Saying figures lie and liars figure. I think that the data, some of it is likely fudged, but I think a lot of it has to do with flaws in the way the data is compiled. And the government is notorious for going backwards and making very substantial revisions. If you recall, the Great Recession, that's what we call the recession that followed the 2008 financial crisis, that one started in December of '07. And extended all the way into '09. But they didn't call that recession officially until December of '08. And what they did is they went back and revised an entire year's worth of economic data. And they said, all the data that we gave you about how great the economy was for the past year, it turns out that none of it was accurate. In fact, we've been in a recession for the entire year. Wow. Nobody knew. And so I think it's certainly possible that a lot of the data that people are pointing to now as proof of the strength of the economy is going to be revised. And maybe it will show that the economy wasn't strong at all. But I think there's a lot of other data that show that the economy is weak. We just don't recognize it. So one would be the record budget deficits and trade deficits that we have. A strong economy would be generating more revenue for the U.S. government and more exports. And so if you look at those accounts, the twin deficits are exploding. It's a weak economy that generates budget and trade deficits. Also, if you look at the savings rate at a record low, basically, household debt at a record high, credit card debt at a record high, these are signs of economy in distress. If Americans were doing better, they would not be relying on debt. In fact, they would be paying down their debt and increasing their savings. That's what you do when times are good. You save more. You pay off those credit card bills that you incurred when times were bad. Well, we're incurring record amounts of credit card debt, and a lot of that is money people are borrowing to buy food. People are putting their groceries on their credit cards because they don't have the money. Also, if you look at the jobs numbers, because that's what the government keeps pointing to, all these jobs that we create, but on balance, we're creating only part-time jobs. We're losing full-time jobs. Wow. I think that's a sign of a weak economy where we're replacing part-time jobs or full-time jobs with part-time jobs. The jobs that we're creating are lower pay than the ones that we're destroying. But the worst part is that most of the jobs that are being created, these part-time jobs, are going to people who already have one or two jobs. Moonlighting is at a record high. People are being forced to take on multiple jobs to pay the bills. And even then they can't pay the bills without going into debt. But if we had a strong economy, people could get by on one job. They wouldn't need a second or a third job. I think the low unemployment numbers don't really tell the story to the true extent, too, that people have detached themselves from the labor market and are no longer included in those statistics. We still have an inflation problem. I think that the CPI broadly understates the severity of that problem by design. So I think we have stronger inflation than we acknowledge. Which means we automatically have weaker GDP growth because the GDP is adjusted for inflation. And so if you're underestimating inflation at the same time, you overestimate economic growth. The economic solution that the Fed has always come up with for every problem was inflation. In fact, if you think about quantitative easing, that's just a euphemism for inflation. Right? Quantitative easing is inflation. It's printing money and buying government bonds. That's inflation. That's right there. You're inflating the money supply. That's where the word comes from. It means inflation means to expand. And it's the money supply that gets expanded. In fact, if you get an old enough Webster's dictionary, that's what it says. That inflation is an expansion of the supply of money and credit. Prices simply rise as a consequence of inflation. They are not inflation, nor do they cause the inflation. They result from inflation. So if the Fed has always created inflation to get us out of every recession, if we finally have a recession that's actually caused by high inflation, where high inflation is the major problem that is confronting the economy, how does the Fed then use its standard playbook of more inflation to solve a problem that in and of itself was caused by inflation? And so that's why they're in a no-win situation, right? You can't fight inflation with more inflation. And it's not like, fight a hangover by taking another drink, right? Just, more of the dog that bit you. That isn't going to work. More inflation isn't going to solve a problem of too much inflation. We had massive inflation unleashed by the government. It was the Treasury in tandem with the Federal Reserve working together to flood the economy with inflation. And now we're experiencing the consequences of all that new money being created and spent into the economy. Prices are going higher. They're going much higher. We're still early in the process where prices are adjusting to a new, much higher level given all the new money. But, people's wages haven't kept pace. And of course, people's savings aren't tied to the inflation. So everybody is being made a lot poorer. I mean, the people who are benefiting are the very rich who had a lot of debt and owned a lot of assets, real assets like, stocks or real estate. Inflation served them well, but the general public, was harmed substantially. Again, that's why Biden is so unpopular, because the people who are scoring him so low are living in the reality of this lousy economy. They don't exist in the fake world of statistics.
In conclusion, Peter Schiff's analysis presents a stark contrast to the mainstream narrative, highlighting significant economic concerns such as flawed data, low savings rates, high household debt, and the implications of continued inflation. Schiff's insights are just to critically examine the true state of the economy and the potential long-term impacts of current monetary policies. If you found this content informative and want to stay updated with the latest economic insights, please give this video a thumbs up and consider subscribing to our channel. Don't forget to hit the bell icon to receive notifications on our latest uploads. Thank you for being a part of this journey with us.